Welcome to the first ever Your Economy, Your Credit Union video casts, where we will help credit union leaders across California and Nevada prepare for what's happening in the local economy. My name is Matt Rye. I'm Senior Communications Manager for the California and Nevada Credit Union Leagues, and I'm joined here today with William Ibrahim, Vice President of Finance and Treasurer for Schools First Federal Credit Union, headquartered in Tustin, California. Schools First is $27 billion in assets, serves 1.3 million members across the state of California and other states as well. Nader Moghadam is with us as well. He is CEO of Financial Partners Credit Union, which is headquartered in both Downey, California and Costa Mesa, California. Financial Partners is $2.3 billion in assets, serving nearly 90,000 members across both Southern California and the Bay Area region. And of course, as always, we have Dr. Robert Eiler, contract economist for the leagues, as well as a longtime board member of Redwood Credit Union in Santa Rosa, California. Redwood Credit Union is $9 billion in assets, serving 340,000 members across 8 counties in Northern California. Gentlemen, I want to thank you for being here today for this important conversation. Well, we want to dive right in. As we all know, Chapman University's A. Gary Anderson Center for Economic Research, which is headquartered in Orange County, just held its 2023 economic forecast event this month, December of 2022. And as we all know here, the forecasters are predicting somewhere between a mild to a moderate economic recession, sometime in the middle of next year. This is obviously, front and center for many financial institutions, as well as other businesses and consumers in the local community. And it obviously has implications for credit unions as well, their members and the households that they serve. But as we all know here, what exactly is in store is a bit of a question mark going forward, especially since the devils are in the details, so to speak, regarding how this recession will look and feel compared to others in the past. You three gentlemen had the opportunity to either attend the event or to review the forecasts for what's coming next year for the Southern California economy. So, Dr. Rob, I'd like to start off with you with the first question, and then you can take it from there. But the first question here that I want to pose on this discussion is, we're transitioning into next year under some pretty heavy assumptions about what, let's say, will happen versus might happen in the local and state economies. And so from a credit union perspective and different planning angles, how can assumptions and predictions within the forecast inform credit union leaders as they take that leap into next year?
Sure. So thanks again for doing this, Matt. The main things you should pull out of the forecast from Chapman is that we're going to have a slower year next year in terms of economic growth. And you're also going to sort of lift off this, bottom piece we've seen in unemployment, meaning that we're going to see more job loss. We're going to see more people re-enter the labor force, which means it's going to pick up a little bit on the unemployment rate. So at the national level, we're going to see a little bit of the reversal of the gains we've seen over the last couple of years as we emerged from the pandemic. But some of that we had to kind of expect. So the specter of inflation is still going to stick with us probably most of 2023, even though interest rates have increased relatively rapidly here in 2022, and the Federal Reserve has been very focused on calming down the inflation pressure that's been there basically since the early portion of 2021. The key is that the pain we're going to feel as a result of those interest rate increases is mainly going to be felt now in 2023. And there's these, what economists think of as monetary policy lags, that when interest rates rise, they don't immediately affect the economy. They take time to move through. And I'll talk about this in just a second. But as they move through, you're trading off inflation reduction for an increase in unemployment. And the middle part of that is because business investment and consumer spending slow down as interest rates pick up. So it's sort of this balancing act, and this classic opportunity cost idea with economists is that you can't have, unless you get real lucky and the supply side of your economy is growing, you can't have reducing prices and a growing economy happening simultaneously. So the Federal Reserve is trying to find that balance. There is some pain in that balance. And one of the main macro variables, and Chapman points this out, that we're going to see next year decline is going to be business investment. And some of that's in construction. Now, what that does, it starts to affect the state and local economy if we see developers start to contract how much they're building in terms of both multifamily and single family homes, where some of that is because the forecast for home purchases and home prices is going to start to fade a little bit. But that's after 3 years of very strong growth in housing markets. And that, again, we had to expect that cyclically we would see some downturn in housing prices, but that should start to move back in toward construction employment, total construction demand, and some of that will then start to have what we think of as a sort of a reverse multiplier effect in our local economies throughout California, where Orange County and Southern California generally are going to see some of that impact. And when you start to move down through the state forecast, it's going to follow us a lot of the same rules or a lot of the same things that are happening at the national level. Pick up in unemployment, downturn in the growth of employment, and ultimately we're going to see housing prices fade a little bit. And that's really where the credit union nexus starts to happen at the local level, is how will members react to some folks losing their job, maybe their neighbors losing their job, they keep their job, relatively high inflation, relatively high interest rates, and thinking about how you're looking at your budget every month and what you're going to spend on and what you're not going to spend on, which also has an effect on the local economy. And then thinking about your home prices. We tend to be very myopic when it comes to home prices. When home prices are rising, we think that this is the way things should be. When they fall, everybody's got a stomach ache until they start to rise again. So that myopia playing out is one of the biggest pieces of education credit unions can do, is to try to make people remember that when you buy a home, you're not buying a stock. You're buying something in which you're living in it. You don't have to rent when you buy a home, so you're getting that additional, what you think of as housing services, as a result of also owning and getting the capital gains, which is maybe what you're more focused on when you buy a home for some people. But it's not to panic as those prices start to fall. In a sense, you have to think more long term, and a lot of that education is what credit unions do really well. But from that side of it, the way lending is going to take place, the way that people are going to use their deposits, we're going to see a slight reversal of the last couple of years in terms of maybe this heady time coming out of the pandemic. There's going to be a few more challenges for credit unions as a result of what we're seeing in the Chapman forecast, specifically in places like Southern California and Orange County. So with that, what I want to do is I actually want to transition and talk more specifically about the credit union situation. So Nader, why don't you start telling us about what you all are seeing at Financial Partners in such a way that when you're thinking about planning, what is a forecast like the Chapman forecast telling you y'all have to be thinking about from a strategy standpoint?
Yeah, thanks, by the way. You did a great job in terms of summarizing some of the broad, messages out of the forecast. And one comment on that one is, when we had our economic forum back in August, there were a lot of suspicions, but now this was a confirmation, and with good data that we're moving in that direction, which is recession. Now we're seeing it in actual practical terms, right? The raising retail deposits is becoming more challenging. There are a lot more folks out there right now, having to adjust their pricing and having specials out there and so forth. On the credit side, the HELOC portfolio, our HELOC portfolio has grown by 70% year over year. And that's speaks to the trend that you were talking about. People are not refinancing anymore because it doesn't make sense to refinance. And if they want to take cash out, they're basically going after their equity lines. Credit cards have also increased by 20%, the balances already, and that will continue to increase. So the other part of it, the other end of it is as the job employment picture softens a little bit, delinquencies and charge-offs are going to become more of a issue than we've been dealing with in the past. So we're seeing that in our delinquency numbers slightly. They were super low. They're now low. Charge-offs haven't started to materialize yet, but that's to come at some point later. So as we're looking in the future, our funding sources, the retail funding sources are a little challenged. The appetite for new loans in mortgage loans is a little bit limited. And then obviously a little bit more prudent look at our credit structure and credit risk I think is really prudent as we move forward.
And that seems to be a theme that I see as a board member, that we're looking at this sort of how strategy shapes in a time where we've had unprecedented change in the Fed funds rate and the aggressiveness of, and I shouldn't say unprecedented, we've seen it historically, but not very recently. But the idea is that because it's been 30 years since there's been this much aggression, and really it's almost been 40 since there's been this much focus on reducing inflation very quickly, that change has this weird effect for some credit unions who maybe have prepared for that change in the way that their balance sheet is allocated, and other ones that might have a little bit more risk exposure. So William, can you talk about what Schools First has in terms of their thinking forward as interest rates have increased and there may be some concerns about liquidity, or maybe not?
Yeah, absolutely. I think one of the interesting things that came out of the Chapman forecast was their confidence that inflation has peaked. It was one of the things that they stressed at the forecast, and they pointed to some of the historical data. But that's going to be absolutely critical in terms of planning for the upcoming year, because you can end up in two different recessions depending on whether inflation has peaked or not. If you look at the outlook from Chapman, if they're right and inflation has peaked, that means that the Federal Reserve now has an opportunity to loosen some of those screws that they've been tightening, which may provide some of the liquidity relief that Nader was alluding to in terms of the issues that are out there. But if they're wrong, and inflation has not reached its peak, and the Fed needs to continue some of their tightening actions, that's a completely different outlook that credit unions need to plan for. They're two completely different paths, and it's going to be important for all of us to make sure that we're prepared in either situation. So those are some of the conversations that we're having at Schools First.
Absolutely. And one of the very intriguing things about this episode, and Nader talked about this right before we got on the call too, is how this is a different situation, is that the Federal Reserve's plan is very much based on the idea that inflation is a demand side phenomenon, meaning that as interest rates rise, you actually have the toolbox to twist inflation back down. And we're starting to see the seeds of that over the last few months in the data. But to your point, if it hasn't quite peaked yet, and to actually more generalize on that issue, if it actually turns down, but is very stubborn about going back down to where the Federal Reserve has it as a goal structure, they may be tempted to force interest rates up even a little bit more, which can exacerbate some of the inflation pressure and does not solve supply side inflation problems. And what that can do is it can extend out the time it's going to take to reverse this trend and kind of wobble through the slowdown or recession, whichever one comes. So Chapman, just to be clear, is predicting recession in a technical sense the last 2 quarters, like similar to what we had in the first 2 quarters of this year, for the last 2 quarters of 2023. That is pretty much mirroring a lot of the other forecasts that are out there in terms of the blue chip forecast and a lot of the folks that are out there doing forecasting for the US economy. One of the things about this California economy is whether or not we lag or lead that change, and how much we have as, you could say, foundational buffer against going deeper than the rest of the US economy, because other parts of the economy actually have a little bit more exposure on housing risk than California does, believe it or not, because they've seen much more of a jump in housing prices, and they may see much more volatility as housing prices come back, especially if interest rates creep up again, which is kind of your point. How does that, if that prediction does not play out, what does that mean for 24 and 25? And I think from a credit union standpoint, we need to have that balance. So now, are you also watching liquidity very closely and thinking about how you need to balance between those forces?
Yeah, absolutely. And you know, the fact of the matter is that you know, a lot of that you know, excess savings that occurred during the COVID period is getting, you know, burned up right now.
Yeah.
And that means that you know, a lot of us in the credit union world are facing with the reality that we've got to get better in helping our members, you know, with some of their savings decisions, laddering, you know, talking about insurance and talking about, you know, their positions, so that we ensure that we retain the fundings, the retail funding source for our business. So I'm beginning to see that you know, and you can see it right now that you know, we all as a group are working very hard to retain and grow our deposits at this point in time, or shares at this point in time. There are opportunities here, and those the question then becomes, when you have a lot of over the last few years, we've had a lot of money flow out of term deposits into liquid savings, and that is exposing us to members who didn't make a difference to them to decide whether they stay in a term instrument or a liquid instrument. Now they basically have a big decision to make because the gap is now so substantially large. So there's going to be some outflows and impact on cost of funds, on the retail cost of funds that can occur within the credit unions. And that's something that we got to be very careful in managing. And then at the other end of it, you've got these mono players out there that have these really interesting offers in terms of rates that are also playing in the marketplace.
And William, to that point, are you all at Schools First starting to see more and more of those mono players out there starting to creep rates up, and the idea that they are seeing the same phenomena and that they're reacting to it by saying, well, we have to be more aggressive in terms of rates? So as you all are scanning what's going on out there, are you seeing that, and how are you all reacting to that as a strategic issue?
Yeah, we're absolutely seeing that. And you're always going to have these outliers who try to push the market in certain ways. The particular focus for Schools First is we want to make sure that we offer highly competitive rates across the board. Right? We don't want to be specializing in specific products at the expense of other products. We want to be able to offer our membership value everywhere. And so it is a challenge in that sort of environment where you do have these outliers. And that's where I think it becomes a key for credit unions to make sure that we're identifying with our membership. We're there to provide whoever our members are, to provide the needs of those individual members, that we can create value across the board. So it's not just rates, but it's also these other things. And that's particularly important today. Right now, when we look at our share balances as an example, our average shares per member are still very high. You look at credit card utilization, it's still lower than where it was pre-pandemic. And that would seem to indicate that our members are doing well. They have savings and they don't have a lot of debt. But that can be misleading, because the way that the Federal Reserve and the way the economy has gone over the last 3 years, it's impacted groups of people very differently. You have some groups who have benefited, and you have other groups who are struggling. And as credit unions, it's important for us to take a look at those relationships that we have with our members, that closeness that we have, and to identify those pockets that are struggling. Even when you step back and you look at data, averages can be very misleading. It's very important to identify those pockets of members who need help and addressing that. And that's how you build the bond and the relationship with members that goes beyond rates. Now, you still have to offer, obviously, competitive rates, but the idea is that you try to put together the entire package so you don't get caught up in some of these rate games.
Absolutely. From a board standpoint, one of the things I always think about when we're in the board meetings and I'm looking through the packet and I'm thinking about what's going on in the industry is sort of two things mainly. One is, how is the customer experience / member experience evolving during a time in which there's a lot of transition economically, there's a lot of change in terms of expectations. There could be job losses that are affecting the way that members use the credit union. What does that mean from what we should be doing as a credit union to serve those members? And the second piece is, where are the opportunities? So now tell me about where you all are seeing opportunities in this marketplace, because even though there's a lot of challenges and a lot of headwinds in the Chapman forecast, if there's anything it's really telling at sort of a 10,000 foot level, is that the headwinds are starting to blow hard on us, but that may not be as strong as previous recessions, but that Southern California, specifically Orange County, that they pick out in the forecast will definitely feel some of those headwinds, but there has to be opportunities in those challenges. Where are y'all seeing those opportunities?
Well, I think I want to build on the 2 points here. One is that, our relationship with our members and our ability to continue focusing on service and creating value, I think comes in, is really important right now, because in an environment where somehow pricing is going to be a big differentiator as things are going right now, especially on the savings side of things. At the end of the day, is helping the members see the value over the long run that we've had their back, I think is really important. The other part is, as you said, being proactive in helping our members who may not necessarily have had to budget tightly over the last couple of years because there was some, slush funds available, to help them basically realize greater financial hygiene, if you will, and being proactive in front of it. Because the environment that we might be embarking on here is actually the moment that helps the credit unions shine, because credit unions do best when there are pressures out there. And I think that we can really build on that by being proactive and being engaged with the members. So I think it's really important to go back to our core while we're dealing with all these, waves that are coming our way, but stay focused on our bottom line relationship with the members and making sure that we gain greater loyalty as we go through this turbulence.
Absolutely. And one of the things that economists, and me being one, talk about big time is that recession is not the natural state of affairs. Economies want to grow, but recession is usually the stomach ache we remember rather than that 10-year period where everything was going really well. We remember the 20 months where things just sucked. So it's hard to cure people of that thought pattern, but it's critical for leadership to help membership in such a way to be looking beyond what will be this turbulent sort of downturn time. And so that's great that you said it that way, because I think it's important in any corporate setting, but really for the membership to know that leadership is seeing beyond this. And William, have you guys thought also about where the opportunities are and what are you guys seeing?
Yeah, I think Nader summarized it perfectly. It's going to come down to the needs of our members, and as Nader mentioned, this is the time when credit unions shine, when we're able to have that high touch, personalized interaction with our membership. They look to us differently than they do to some of these bigger institutions. We've seen in the past that when times are tough, they turn to us, and we need to make sure that we're able to provide for them in those moments. Because if we're not able to do that, then who are we? And they're going to forget us the next time, because there's not going to be any differentiator. So that's going to be key, and that's going to manifest in a few different ways. If the recession does come, we're going to start to see those losses, those things that were masked. There were cracks that maybe got covered up by these excess funds, and that strain is going to show through as those excess funds dwindle and the employment environment gets a little bit more difficult. And so things that are easy to gloss over are going to start to come to the surface. And we need to make sure that when it comes to outreach and working with our members to make sure that they're in the best possible financial condition, and when they do struggle, that there's someone there to help them, is going to be immensely critical for us and the success of credit unions. Robert, I do have a quick question for you. One of the things that Chapman mentioned at the forecast was this idea that residential investment is going to be one of those areas that is going to bring down consumer spending. You mentioned earlier that other parts of the country are more susceptible to changes in housing, but I also know that Southern California in particular, maybe to a lesser extent today, but to some extent still, is built around all of these kind of satellite industries built off of housing, mortgages and construction and everything that surrounds this topic of housing. If that starts to decline, are you seeing a bigger impact to us and our members here in Southern California?
Yeah, that's a great question. So construction investment is normally one of those places economists look at when they're forecasting as a leading indicator. And then you should see it kind of move in waves, meaning you're likely to see residential go first, commercial go behind that, and then general investment kind of hit behind that. And it kind of goes in that domino. So generally, home building is the first one to go. and when you know you're going to go into a downturn. So there's no doubt about the fact that, especially over the last couple of years, we've rebuilt some of the superstructures we had in the 2000s around trying to facilitate home lending, trying to facilitate home building, having these burgeoning prices and this lack of supply. A lot of that has tried to bring in other players to try to fill in some of those gaps, and Southern California is no different. So there is some risk the more elongated the timeline is. The funny thing about why this is a little bit different this time, is the supply chain chokehold actually has now elongated the timeline for projects. So in a kind of a weird way, that it's possible, and you're hearing some of this around the builders industries, or around the building industries, is that because they've waited for inputs for so long, they've had to string out projects that might have taken 12 months to 24 or sometimes to 30 months. What that has done is it means that there's this sort of backlog that actually could bridge over troubled water for some time if the money's already there and we don't see people pulling out from projects. And that's the one big critical strategic threat to construction, is not so much the macro economy slowing down, but whether or not that slowdown actually triggers, well, look, we're about 2 months deep in a 20-month job, we're going to stop now, right? Rather than playing that out under the supposition the recession will be relatively light and we'll get on the other side of it. That's why we watch construction, both residential and commercial, as an indicator, because if people start pulling out of projects and that spending starts to sag more quickly, it suggests that all those other connections are going to start to pull back as well. And that's where the broader impacts happen. So we're hoping, and the Chapman forecast talks a little bit about this, but what we're seeing more generally around the US is that it's fading, but it's not fading at the same speed we've seen in previous recessions. And it may only fade in such a way to have a relatively mild effect rather than a repeat of what we saw, let's say, in the early 90s, the early 2000s, and then big time when we hit the Great Recession. If we can avoid that, that actually will avoid a lot of the trouble. And to a certain extent, the unemployment forecast and the employment growth forecast you see in the Chapman forecast suggests that broader multiplicative change will not necessarily be that big this time. So it will have an effect, but it probably will not have a large one. And some of that is going to be, in a sense, the benefit that we receive from having these projects strung out for a longer period of time than you move. If you're already deep into a project, but you know it's going to take another 18 months because of supply chain issues, the money might already be there and you want to see it out because that 18 months will get you on the other side of the problem. We'll see. I'm hearing that story, which is actually a good story in terms of the mildness that may be coming.
Interesting way of looking at it. Actually, I'm glad that we're having this discussion. The other part is that, from a practical standpoint, as a credit union operator here, one of the key things that I think comes to mind is it looks like from a mortgage activity standpoint, we're going to have a more timid sort of an environment as we're moving forward. And a lot of credit unions have been busy building their mortgage factory, if you will. There are ramifications there, and part of it is about retooling your workforce in those areas, and helping them get into the other parts of the organization possibly. That's something that we're, for instance, dealing with. We know that consumer credit demand is going to be higher, but the mortgage, maybe it's a little bit it's not going to be that high as we go forward. But equity business is or equity volume is picking up. So it's going to be a little bit of a process over the next year. I think credit unions will have to reallocate resources and training and repurposing and refocusing that are going to take place as an operator. I can see that. I wouldn't be surprised to see some credit unions that have really big mortgage shops do private label work for others. But there's going to have to be a lot more hustle and creative work to maintain first of all the infrastructures that have been built, but also finding ways to more creatively utilizing them. So it'll be very interesting to watch what kind of experiments come out over the next year in terms of how people solve those equations as we go forward.
Yep. And then to start wrapping up, is there one thing in the forecast that gave you the most pause? in the sense you think about Southern California in the context, you think about what Chapman is looking at in terms of the US and state context, and then the real focus on Orange County, and really Southern California more generally as Orange County is a microcosm of that. Is there one thing, one nugget in there that you felt like is the one thing you want to bring back to your board and potentially to your senior leadership team that is the one biggest concern that you want to attack?
You're asking.
Yes, yeah, please.
I think the one that I've taken away from it is that we're going to have to basically rethink about solving the equation differently as we go forward. More hustle, more focus, more creative thinking about and stop praying. Prayer is not a solution. And I think that adjusting sooner rather than later is probably going to be the name of the game. And again, just because some of these macro events take place, it doesn't necessarily change things super drastically, but you have to basically be able to have more agility in thinking about how different parts of your business are going to. For instance, I'll give you one example. Last few years, we've been really focused on lending side of the our thinking. Our frontline teams need to be better prepared to talk about insurance, laddering, finding ways to engage members on a more productive basis, because when the gap between the rates, you're getting nothing and then you're getting a little bit more than nothing on your deposit rates is one thing, but now we have to be helpful to the members in that way. And then the other part of it is with all these constraints that we've talked about is if mortgage isn't going to happen the way it was, then what are some of the other parts of the credit solution that our members are looking for? A more flexible credit, ability to give them the sort of the safety nets through some of the other ways that we can put in place. So I think it's a lot more hustle and a lot more proactive and a lot more creative thinking about making sure that we don't take things for granted. We sort of.
Perfect. William, how about you? Is there one thing that you saw that you kind of want to bring back to leadership?
For me, it's going back to that point from earlier in the discussion, this idea that inflation is because if that's true, if inflation has peaked, then the next year, 18 months will be a little bit more familiar. It's not going to be good, but at least we can draw upon some of our more recent experiences on how to navigate those waters. If you have a recession, but inflation is not really a big focus, then we're going to have losses. We're going to need to be there to help our members and get them through that. But again, the idea is that it'll be familiar territory for us. Mm-hmm. I would just caution that let's not rely upon that. Let's be prepared for it, but let's also be prepared for the alternative where if inflation does continue. That is a different environment. Not only is it different from the low inflation environment, the typical losses, but it's also different in the sense that it's been a long time since we've gone through an environment like that, and we may not have some of that experience and that knowledge to help us through. So it's going to be critical to prep ahead of time for that possibility, and not bank on the fact that we're going to have a typical recession and put all our eggs in that one basket. To me, that's the key takeaway from the discussion at Chapman University.
Cool. Thank you guys so much. And I'll hand it back over to Matt to wrap it up.
Yeah, thank you so much. And I can tell you just a little bit of what we're seeing at the league here since we deal with the quarterly call report data. I think the thing that kind of keeps me up at night a little bit is that dichotomy between the economy and annualized loan growth and annualized deposit growth. William, I think you mentioned a fact a few minutes earlier about still burning off so many deposits, right? Burn off, so to speak, within consumer accounts. And I know, Nader, you had mentioned the mortgage machine that was built up over so many years, and now the long-term rate environment changing. It's been interesting to see going into late 2022, which I think the third quarter numbers are bearing out over California and Nevada, that loan growth is still higher than I would have expected it. So I know that some economists out there talk about recession versus other economists talking about an overheated economy and trying to burn off the inflation, so to speak. So I think that's going to be going in interesting for credit unions from a league perspective going into next year. And we're looking forward to everything that's coming our way. But William, Nader, Rob, this has been a great discussion with all sorts of relevant and useful nuggets of information for credit union leaders and professionals across both states. I know that for sure. I can say that from talking with a lot of them that would get a lot of insight out of this. I also like to recognize you guys for just all the work you're doing at your credit unions from both the board member level perspective and also the senior management perspective at all as well when it comes to discussing the local economy and implications for credit unions. And I want to say to our audience out there that we'll be looking forward to sharing this and other additional Your Economy, Your Credit Union video cast conversations with industry leaders just like Nader, William, and Rob going forward to continually assess how the local economy is impacting your credit union and your members. So again, gentlemen, thank you all for being here today, and we look forward to more discussions in the future. Thank you.
Thank you.
you.
Thank you.